So imagine you've got this machine, right? And it produces the single most critical resource on the entire planet.
Yeah, the kind of thing governments are practically fighting over.
Exactly. Militaries absolutely rely on it to function. And, if this machine were to just suddenly stop, the whole modern economy, I mean, everything from your car to hospital life support systems, it would all just instantly collapse.
Right, it's like the ultimate undeniable strategic asset.
It is. But here is the billion-dollar paradox we're looking at today. The actual underlying economics of running this machine, they're completely, totally broken.
It's a massive disconnect. I
Yeah.
mean, you have this business that is vital to the national security of the United States, right?
Yeah.
But on paper, it's burning cash at a rate that would just terrify a traditional value investor.
Yeah, it's wild to think about. You've got national defense on one side and then this plummeting stock chart on the other.
You're essentially looking at a company trying to save the world, or at least its corner of it, while its own balance sheet is bleeding out.
Right. And today is April 23, 2026, and we are diving into a stack of incredibly timely sources that capture this exact tension.
We've got some great materials today.
We do. We have a massive AI-generated deep value intelligence report alongside this really detailed internal research guide, and they are both entirely focused on Intel.
Which is just a fascinating case study right now.
Oh, absolutely. So our mission for this deep dive is to dissect Intel's brand new Q1 2026 earnings, decode this like radical new leadership strategy they've deployed, and really try to answer the ultimate value investing question.
Which is, is Intel a brilliant once-in-a-generation turnaround play, or is it just a colossal value trap?
Okay, let's unpack this. Where do we even begin to understand the sheer scale of Intel's current dilemma?
Well, to really understand the turnaround, you have to understand the crash.
Yeah.
And to understand the crash, you've got to look at the sheer hubris of their glory days.
Right, because they weren't always struggling like this.
Not at all. If we just rewind a bit, like from roughly 2016 to 2021, Intel was the undisputed titan of the tech world.
They were untouchable.
They really were. We were talking about a company that consistently posted gross margins between 55 and 65%.
Wow.
Yeah. Their annual net income peaked at over $21 billion. They had this near monopoly on the world's computing power, mostly in data centers and PCs.
So they were just swimming in cash.
Exactly. They generated so much free cash flow, they genuinely struggled to deploy it all. In fact, over the last 35 years, Intel spent a staggering $152 billion on stock buybacks.
Wait. Let me make sure I'm wrapping my head around this. $152 billion.
No, $152 billion.
They had that cash over the last few decades, and they just burned it on stock buybacks just to, boost the share price for executives and shareholders.
That is the reality of their capital allocation back then, yes.
I mean, that's like a farmer eating their seed corn instead of planting it for the next harvest, right?
It's a perfect analogy, honestly.
Because looking at where they are today, literally begging for government subsidies, you have to wonder how much the current board regrets not saving, I don't know, even a fraction of that money for the factory investments they desperately need right now.
Oh, the regret has to be immense. But, how did they let that happen? It was the classic innovator's dilemma.
How so?
Well, they thought their manufacturing lead was just insurmountable. But while they were, printing cash in the PC and server markets, they completely missed the mobile revolution.
Right, they passed on making chips for the early iPhone, didn't they?
Exactly. And that one decision allowed a company like TSMC, the Taiwan Semiconductor Manufacturing Company, to step right in.
And TSMC just took that mobile market and ran with it.
Yeah, they used the sheer volume of billions of smartphones to rapidly iterate. They funded their own massive R&D with it, and eventually they simply surpassed Intel's manufacturing tech.
So TSMC didn't just, steal the crown overnight. Intel practically handed it to them by ignoring the phone in your pocket.
That's the tragic irony of it. And, fast forward to today, 2026, and the picture is starkly different.
Yeah, those buybacks are definitely a thing of the past.
Completely halted. The dividend, gone. They suspended it entirely to preserve capital. Today, Intel is carrying over $44 billion in long-term debt.
$44 billion.
Ouch. And their gross margins have plummeted from the mid-60s down to around 35%. Plus, their free cash flow is deeply, deeply negative.
Which means they're spending significantly more cash than they're bringing in. You don't survive that kind of financial whiplash without completely changing who is at the wheel.
And that brings us to the cultural surgery happening over there right now.
Right, the new leadership.
Yeah. What's fascinating here is what the sources refer to as the Lip-Bot-Tan doctrine.
Right, Lip-Bot-Tan, he became CEO in what, March 2025?
Exactly. He's this highly respected industry veteran, best known for orchestrating the legendary turnaround at Cadence Design Systems.
So he comes in, and what does he find?
He inherited an Intel that was caught between its, bloated legacy as a traditional chip maker and the insanely expensive demands of trying to become a global foundry.
And when we say foundry, we mean manufacturing chips for other people, right? Not just their own designs.
Right, exactly. So Tan looked at the old vision, this whole IDM 2.0 thing, realized it was failing, and he pivoted incredibly hard.
Yeah, looking at the research guide, it's obvious that pivot has been pretty brutal.
Beyond brutal. His doctrine is all about ruthless, stripped-down engineering execution. They have executed a massive reduction in the workforce.
How massive are we talking?
Well, in 2023, Intel had almost 125,000 employees. Today, they're down to an estimated 75,000.
Oh, wow. So that's, what, a 40% decline in headcount in just a few years?
Yeah, 40%.
So Tan fires 40% of the staff, rips out the middle management. But he didn't do that just to save a few bucks on payroll, did he?
Not at all. The primary goal was to flatten the corporate hierarchy. You see, Intel had become famous for its endless meetings, the bureaucracy, really slow decision-making.
The classic bloated corporate giant syndrome.
Exactly. Tan's objective is to eliminate those middle management layers and return power to the actual engineers.
The sources mention a shift to referent power. What does that actually mean in this context?
It means managers should lead through deep technical expertise, right? Not just because they have a vice president title on an org chart. He's trying to resurrect the ruthless engineering excellence that defined Intel decades ago under Andrew Grove.
Which makes perfect sense, because putting power back into the hands of the raw engineers is basically the only way they're going to solve the absolute physics nightmare of their next gamble.
The physics nightmare is right.
Let's talk about what they're actually building to try and dethrone TSMC. The sources keep mentioning that Intel is betting the entire ranch on their 18A and 14A manufacturing nodes.
Right, the new node.
Yeah. Let's break that down, because the numbers here are mind-boggling.
We really have to understand the scale we're talking about here. When Intel says 18A, that A stands for angstroms.
Wait, angstroms? That's even smaller than nanometers, right?
Yes, 18A means 1.8 angstroms. We are talking about shrinking transistors down to the literal atomic level.
That is insane.
At that scale, the physics get incredibly weird.
Huh?
You can't use normal light to print the circuits onto the silicon anymore. The wavelengths are simply too big.
So it'd be like trying to paint a microscopic masterpiece with a giant roller brush.
Exactly. It just doesn't work.
So how do you actually print something at the atomic level?
You need something called high-NA EUV lithography.
High-NA EUV. Okay.
Right. EUV stands for extreme ultraviolet. These are massive, incredibly complex scanners built almost exclusively by a Dutch company called ASML.
I've heard of it, and they have a total monopoly on this stuff, don't they?
Pretty much. High-NA essentially uses these larger, hyper-precise mirrors to focus that extreme ultraviolet light into a microscopic scalpel.
Wow.
It is arguably the most complex machine ever manufactured by human beings. And
Yeah.
because of that, a single one of these high-NA EUV machines costs roughly $350 million.
$350 million for one single machine.
Just one.
And you can't just buy one to run a global factory, can you?
No, you need a whole fleet of them for a modern fab. Because of this, Intel's capital expenditures, their CapEx, is running at roughly $25 billion a year.
$25 billion a year, just burning cash.
Burning cash at a historic rate just to put out the equipment.
So how are they paying for all this?
They're leaning on what they call a smart capital strategy. They're tapping into government subsidies through the GPS Act. They're forming equity partnerships. They actually sold stakes in some of their operations to NVIDIA and SoftBank recently.
So they're basically scraping the couch cushions of global finance to fund these massive factories in Ohio and Arizona.
That's a good way to put it, yeah.
But I'm looking at these GPS Act subsidies in the sources, and it feels like a total devil's bargain.
The silicon handcuffs.
Yes. Sure, they get billions in free cash from the U.S. government, but they're slapped with these handcuffs. By taking that money, Intel is barred from expanding any advanced production in China until 2036.
Yep, 10 years.
Isn't capping your access to one of the biggest technology markets in the world a massive strategic handicap? Just to get some short-term factory funding.
Oh, it's a huge handicap. They are strictly locked into a reliance on U.S. and European manufacturing bases for the next decade. But frankly, Intel was in no position to negotiate. They needed the capital to survive.
Right. And here's where it gets really interesting for me. I'm looking at this whole foundry business model.
Catch-22.
Exactly. Intel wants to build these incredibly expensive fabs to manufacture chips for other companies, right? Because they need massive volume to pay off those $350 million machines.
Yes, that's the plan.
But why would giant competitors like AMD or Apple or NVIDIA actually use them?
Well, that's the million-dollar question.
I mean, it's like spending $5 billion to design the world's most advanced bank vault and then handing the exact, highly secretive blueprints to a guy who currently makes a living robbing your banks and asking him to build it for you.
Right.
Why wouldn't these companies just keep using a neutral partner like TSMC?
You have zeroed in on the absolute core vulnerability of Intel's entire strategy. It is a massive industry-wide trust deficit.
A trust deficit.
Yeah. TSMC is essentially the Switzerland of semiconductors. They don't design their own chips. They don't sell processors to consumers. They only manufacture for others.
So they don't compete with their own customers.
Exactly. Because of that strict neutrality, they have built a highly trusted ecosystem, and that trust allows them to command gross margins well above 50%.
And Intel, on the other hand, historically competed directly with the very companies they are now begging to be their foundry customers.
Right. So even if Intel builds a better, faster factory, Apple and NVIDIA are still going to look at them and think, you're just going to peek at our homework and use it for your own chips.
That is a terrifying hurdle for them to clear.
That is the fear. And the Q1 2026 numbers prove exactly how hard this is.
Oh, let's look at those.
So Intel's total foundry revenue was $5.4 billion. But almost all of that was internal.
Meaning Intel's manufacturing arm building chips for Intel's design arm.
Yes. Their external foundry revenue, actual money from outside customers, was a tiny $174 million.
Wow. Out of $5.4 billion.
Yeah. So beating TSMC isn't just a physics problem or an engineering problem. It is a massive psychological and business problem. You have to convince your fiercest rivals that you won't steal their lunch.
Man, okay, so the risks are established, the stakes are existential, and that trust deficit is very real. But let's look at the actual pulse of the patient. The Q1 2026 earnings just came out. Is this radical, incredibly expensive gamble actually working?
Surprisingly, yes. There is a pulse,
Yeah.
and it's beating stronger than many analysts expected.
Really?
Yeah. In Q1 2026, Intel's total revenue hit $13.6 billion, which is actually up 7% year over year.
7% growth for a legacy company this size, right in the middle of a chaotic turnaround. I mean, that's definitely nothing to sneeze at. Where's that momentum coming from?
The brightest spot by far is the Data Center and AI segment, or DCAI. That division surged 22% year over year.
22%.
Yeah. What's happening is that the broader artificial intelligence market is maturing. For the last few years, all the big money went into AI training, building the massive foundation models.
Right, and that market is completely dominated by NVIDIA's GPUs.
Exactly. But now, workloads are shifting toward AI inference.
Break that down for us. What is the difference between training and inference, and why does that shift help Intel?
Okay, so training is like sending thousands of computers to school to learn a new language.
Right.
It requires massive brute force power.
Hence the expensive NVIDIA chips.
Right. Inference, on the other hand, is using that language in the real world. Like when you ask a chatbot a question and it generates an answer,
Oh, okay.
you don't need a massive, expensive NVIDIA GPU for a lot of inference tasks. You just need a highly optimized, efficient processor.
Mm.
And Intel's new Xeon 6 processors are highly tuned for exactly this. Right now, server demand for inference is actually outstripping supply.
Oh, wow. And it's not just the big server farms either, right? The sources highlight this massive boom in what they're calling the AI PC market. Think about the laptop you're using to listen to this right now. Intel is betting its survival that the next time you upgrade, it has an Intel Core inside, specifically designed for AI.
Yeah, their client computing group is seeing a real renaissance. AI-related businesses now make up about 60% of Intel's total revenue.
That's a huge pivot.
It is. They recently launched the Core Ultra Series 3, and it's already powering over 200 different laptop and desktop designs from major manufacturers.
Which is crucial because it proves Intel is successfully fighting off the ARM-based competitors, doesn't it?
It absolutely does. For a while, it looked like everyone was going to abandon Intel's traditional x86 architecture and move to mobile-style ARM chips for better battery life.
Like Apple did with their M-series chips.
Exactly. But Intel is proving they can still deliver the power, efficiency, and performance needed to run AI directly on your device.
So we have revenue growing 7%. We have a massive workforce reduction, making them leaner. They are successfully launching new AI chips for servers and laptops.
Right, sounds great, doesn't it?
It does. But then we look at the Deep Value Intelligence report, this incredibly robust multi-agent AI framework that analyzes the stock for value investors. And despite all this good news, it slaps Intel with a strict red-letter avoid rating.
Yeah, and avoid for value.
Now, it gives it a watch for growth investors, but for value, it's a hard pass. So what does this all mean? If you're a value investor looking at that $67 share price right now, you might be tempted to jump in. How can the business be showing signs of life, but the value verdict is so negative?
Well, if we connect this to the bigger picture, it all comes down to the fundamental difference between an exciting turnaround story and a true value investment.
Okay, unpack that.
Warren Buffett's style of value investing demands three non-negotiable things: a highly durable economic moat, predictable earnings, and a high return on invested capital, or ROIC.
And Intel fails those tests right now.
Spectacularly. Let's look at the moat first. Intel's moat used to be manufacturing supremacy.
Right.
That is gone. TSMC has it. As for predictable earnings, Intel's profits have been a roller coaster for 5 years.
So that's two strikes.
But the most damning metric is the return on invested capital. It is essentially zero right now.
Zero.
Yeah. When you are pouring $25 billion a year into new factories and your ROIC is zero, you are destroying economic value in the short term, just hoping for a payoff in the long term.
Yeah, the sources mention the intrinsic value model in the DVI report. The market is currently pricing the company at around $324 billion, with shares at that $67 mark.
Right.
But the report says the intrinsic value based on owner earnings is drastically lower. How does that math work?
Owner earnings are essentially the reality check of investing. It's the actual cash you get to put in your pocket at the end of the day, after paying for all the necessary upkeep of your business.
Okay.
Because Intel's CapEx is so astronomically high right now. Remember the $350 million machines?
Hard to forget.
Just to build these new fabs to stay relevant. Their owner earnings are actually negative.
So it's like buying a rental property where the monthly rent doesn't even cover the cost of replacing the roof every single month. You might own a house, but it's making you poor.
Exactly. You cannot mathematically calculate a positive intrinsic value for a business that has negative owner earnings.
That makes a lot of sense.
The report concludes that at $67 a share, there's absolutely no margin of safety. The market is currently pricing Intel's stock as if Lip-Bu turnaround has already succeeded.
They're jumping the gun.
Completely. Investors are pricing in the 18A node working perfectly on day one. They are pricing in the foundry business suddenly winning huge external clients despite the trust deficit, and they are pricing in a return to massive profit margins.
And if any one of those things fails or is even slightly delayed,
The stock has massive downside risk.
so people are buying the hype of the national importance, not the reality of the balance sheet. They're confusing a strategic national asset with a good economic business.
That is the crux of the issue right there. Think about the railroad industry in the early 20th century. Railroads were absolutely vital strategic national assets. The country couldn't survive without them. But for a long time, their massive capital costs made them terrible investments for everyday shareholders.
So just because the U.S. government desperately needs Intel to survive doesn't mean Intel's shareholders are guaranteed to make money.
Precisely.
That is such a vital point. The government cares about the microchips being made on U.S. soil. They don't necessarily care if your individual stock portfolio goes up. The government might provide a floor against bankruptcy by offering subsidies, but they don't provide a ceiling for your profit margins.
Exactly. Intel still has to actually earn those margins by out-executing TSMC and NVIDIA in the open market, which is arguably the hardest task in modern technology right now.
So for the disciplined value investor, the strategy right now is just what? Sitting on your hands.
Pretty much. You watch the node progression. You watch to see if they actually sign a massive external foundry customer like an Apple or an AMD, and you wait to see if those gross margins actually climb back up toward 50%.
Right. Until the underlying economics actually prove themselves in the real world, it's a massive, fascinating gamble, but it's not an investment.
That's the final verdict.
Yeah.
It's an incredible industrial drama, but it requires far too many optimistic assumptions to qualify as a safe value play today.
Yeah.
And that brings up one final overarching question to really think about as we watch this play out.
What's that?
What happens if this grand, deeply expensive plan doesn't work?
Oh, man.
What if the 18A process node falls behind schedule? Or what if the foundry business permanently fails to attract those big external customers because the trust deficit is simply too large to bridge?
Right.
Will the U.S. government simply let its only national semiconductor champion fail? Or Could we eventually see a scenario where Intel is forced to split entirely?
Splitting the company.
Yeah, separating its highly profitable asset-light chip design business from its heavy, capital-burning manufacturing fabs forever.
That is a massive call, and it really highlights the razor's edge Intel is walking right now. We will definitely be keeping a close eye on their progress over the next few quarters. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. Track total market temperature. Welcome to search and download iOS app Buffett Indicator from Apple App Store. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.